Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here, your regular host, with my friend and colleague Jeffrey Roach. Jeffrey, back from the slopes. How was skiing?
Good time. Glad to be back watching markets, but it's hard to watch markets while you're going down the mountain, but had a great time. No broken bones.
Wonderful. I will not draw an analogy between ski slopes and the markets because that could certainly mean bad things are happening. Nor am I going to draw an analogy between my Kansas City Chiefs and the markets either. I think this is more of a Philadelphia Eagles type market. And I'll just leave it at that. Congratulations to the Eagles. So, of course, it's the day after the Super Bowl, Monday, February 10th, 2025, as we're recording this. We got a great show for you today. This is a really fun one, I think, to walk through the weekly market commentary this week, key pillars of the bull and bear cases. So we just pulled out, 5 bull points and 5 bear points, and we'll walk you through those. The message from us here is really don't pick a side. Because certainly we think elements of both the bull and the bear case will end up coming true in 2025. As we always do, we'll start with a market recap. Tariff turbulence is my headline there. Probably the biggest reason why we were down a little bit last week, although earnings had something to do with it as well. And then we'll finish up with a preview of the week ahead, where, of course, Jeff, you know this data as well as anyone, so you can tell us what to look for in terms of the inflation reports out this week. So starting with the recap, so here you see we're down a little bit. S&P 500 down 0.2% last week. It was really tech weakness, or we'll call it Magnificent Seven weakness that you see here when you look at the sectors. Consumer discretionary down, communication services down, and actually the tech sector did okay because it was really about Alphabet and Amazon. That aside, certainly with the tariffs going on and then coming off in Canada and Mexico, you had some volatility around that. Chinese tariffs go on today. Markets certainly are nervous about where that could lead. So I would say those were probably the biggest reasons why we were down last week. Any observations last week, Jeff, in terms of how the market interpreted the economic headlines?
Right. Well, there's definitely some interesting economic news in Europe. So a little bit uh, dicey to read these charts for our regular watchers. Basically, here we are beginning of February. Look at those year-to-date numbers. That'll give you a little bit of a broader snapshot than just the last week. And you look at how Europe has shown some pretty decent strength. I think the key takeaway there is to consider, number one, they're coming off some lows because of some really serious headwinds last year relative to U.S. markets. But secondly, you just want to remember there's a little bit of recovery showing up in Europe, particularly in the services sectors in Germany. So we have that if you're looking at the right side of your columns there, the DAX index, which is the German version, more or less, of the S&P 500 benchmark, almost double digits for the year as services part of the economy improves.
Yeah, and you don't even have to deduct currency, right? Because the dollar's been pretty stable this year. So solid gains. International equities are actually helping out equity portfolios this year. Certainly something we haven't seen in quite some time. I should also mention, and this will come up when we talk inflation later, that University of Michigan survey of inflation expectations was really hot, up a point to over 4% in terms of consumer expectations. So that was a part of the weakness on Friday, which led to the down week. Although we did have a pretty cooperative bond market. So, bond market didn't really move much. This sort of 5-day look is up in the ag, the broad bond market index up 0.4%. So, now we're right around 449. I'll show you a chart of the 10-year here in a little bit. But it looks like that 450 level that we've been watching from a technical perspective could be broken. We'll see. It's on the cusp. Also, a lot of gains in commodity markets last week, which is interesting. Oil's actually up again today. Energy stocks, on as we're recording this Monday afternoon, energy stocks are doing quite well today. But look at gold. Gold's just been surging, up over 2,900. You have industrial metals up over 3% last week. So, tariffs are part of that because aluminum and steel tariffs are going on, or at least the Trump administration announced that they are planning for those to go on. So that may be part of it, but I think maybe the market is also sniffing out a little bit better global growth, which Jeff, I guess you alluded to with the European comments. So thoughts on commodities or currencies?
Yeah, the currencies. So bottom right box there. Look at the euro. So euro dollar close to parity. That's happened. That's started to approach parity really in the last several months. Saw a little bit of weakness in the last week or so on the dollar, given, as you suggested, Jeff, on some of the inflation fears. But generally speaking, dollar is holding up well, and maybe now's your time to take a European vacation. What do you say, Jeff? Or is that
A
in
lot
the
of
works?
not in the works, but certainly a lot of folks have been traveling overseas the last few months. I
So
have
close
noted.
to parity, you see that 1.03, just one level below that British pound, 123, almost 124, rounding up. That's certainly um, revealing the strength of the U.S. dollar at this time.
Yeah, we're still pro US in terms of asset allocation, but you have gotten two ingredients that you need for international outperformance. Number one, weakness in US mega cap tech, and number two, a weak dollar. Now it's just seven, whatever, 7, 8 days that we've seen the weak dollar, but we are seeing a little bit of a weak dollar here. So that'll be something to watch. So thanks for that, Jeff. Let's go to the bull and bear case where we spend most of the time. This is a fascinating exercise to go through, and it really it reflects just how tricky this market is because there are really strong arguments on both sides. So we're not really picking a side. We've kind of taken elements of both sides in our outlook for 2025. And, I would say we're a little below consensus on earnings and stock price appreciation. But at the same time, if we get weakness on some of these risks, we may be in a position to get more aggressive here. So that's how I would frame it. It's obviously a little bit of art with the science. So we've got charts on most of these bull and bear case points. We'll start with the bull case: double-digit earnings growth, robust economic growth, stable or slightly lower interest rates, tax cut extensions, which we're likely to get, and seasonal and technical factors. So starting with earnings, here is a chart of S&P 500 earnings growth for Q4. And when I ran this late last week, it was 15%. It's up closer to 16% now. So very strong. Of course, that's 2024. If you turn to 2025, you continue to see at or near double-digit pace. So there's a lot of earnings growth underpinning this market. It's helping stocks grow into the valuations. And, the Mag 7 is certainly not slowing down its spending. And where's a lot of this earnings growth coming from? It's coming from the Mag 7. So, in fact, of those, let's call it 15.5% earnings gains, almost half, about 7 points, are from the Mag 7, and we haven't gotten results from NVIDIA yet. So that could end up being over half when all the numbers are in. So really strong support here for markets from earnings. Next, strong economic growth outlook, slowing, but still pretty strong. Jeff, your thoughts here? This is pulled from our 2025 Outlook publication that we put out in December, which you can find on LPL.com.
Yeah, yeah. So top right in the box there, 1.9. That's under 2025. That's real economic growth for the year. And we're basically saying, look, we're probably slowing down to trend. We've been above trend growth the last couple of years and down to trend. So when you hear someone talk about slowing economy, it's where's the destination? And trend growth is certainly not a bad thing. Certainly driven by a decent job market. Consumers are getting paid pretty well historically, where we would see that is naturally rolling into a pretty robust spending on the consumer side, and then of course the business side continues to keep doing well with demand for capital expenditures, and that's certainly supporting the economy as well. So that is definitely in the bull side of the arguments here.
Yeah, artificial intelligence keeps coming up because it's such a strong driver of the economy and of earnings. So you could also turn that into a bear case argument as well. If you want to make the case that these companies are spending too much money and they're not going to get payback for all of that investment. That will be a debate that will probably continue throughout the entire year, maybe even in 2026. But for now, we're giving those companies the benefit of the doubt that they're going to get productivity increases and the cash flows they need long term to justify those investments. So next, the 10-year yield. So key element of the bull case is for yields to behave. And you can see here, we're on the cusp of breaking down below that 4.5 level. If you break below, this is technical perspective, if you break below 4.5, brings 4.25 into play. And which is our forecast for year end. And if the economy slows, as Jeff, you and the team think it will, then that could lead to less inflation pressure. So we think we've got the makings of a stable or maybe a slightly lower 10-year yield this year. But as you'll see when we get to the bear case, there are certainly some challenges to that claim. So key element, we need stable yields. And actually, we talk about this in the commentary, again, the weekly commentary on LPL.com, about how the Trump administration and Scott Bessent, the new Treasury Secretary, are targeting the 10-year yield. And they're going to try to, actually, with the help of Jason Trennert from Strategist, someone who we know and follow closely, they're going to manage that 10-year yield, which means they have to manage the debt and the supply demand of treasuries. So we certainly have confidence that they can manage through it, but it's a challenge and it's absolutely a risk. So next we'll go to the tax cuts. This is, of course, part of the bull case that these will get done. This is a sort of line by line estimate of what all these tax cuts will cost to extend. And you see it's almost 4 trillion. That is a huge number, and we don't think that the Republicans are going to be able to get enough offsets to pay for that entire price tag. So what we're likely to see, this is for a 10-year budget window, is a shorter budget window. Maybe it'll be 5 years to get through the whole Trump term, or 4. And if you extend the tax cuts for a shorter period of time, then they're cheaper. So it'd only be half this, roughly. Right? Remember, when you use reconciliation, you have to offset the tax cuts with spending cuts. That allows you to get through the Senate with 50 votes, which is certainly what the Republicans are going to have to do. So is it possible we get the full 4 trillion? Yes. By the way, this doesn't even include some of the things that President Trump has asked for, like no taxes on tips, no taxes on Social Security, no taxes on overtime. Those are probably not going to get through just because of the cost and the need to offset. Now, what they're doing at Doge with Elon Musk is certainly helping, and what they're doing with tariffs is helping because they're raising revenue, but they still have a ways to go. So this is a bull case, but it's a tricky bull case, we'll say, because
Yep.
it might disappoint the markets by the time we get later in the year and we actually see what they can get done.
Yeah, and
Anything
I
to
think
add, Jeff?
Yeah, well, I think part of the reason why you're trying to get to be able to pay for, how do you pay for it, right? Corresponding cuts in spending. A lot of folks remember back 2001 and 2002, those years where when the economy could grow, and maybe, it slows to trend, but it maybe reaccelerates a little bit into 2026, 2027. A growing economy is the one is the biggest factor in all this, right? So growing tax receipts from more people working and producing, and boy, the numbers are a lot easier to balance when the economy is growing well. Just a reminder in that
No doubt.
regard.
Yeah, so some of these like business friendly regulation, things like that can maybe encourage more capital investment. Things like that will help balance this out too. So we put it in the bull case, but it's not a slam dunk. So next we just call this like seasonal and technical factors. You've heard us talk about this before, the January barometer or the January effect. When you're up in January, and we were up 2.7% on the S&P 500, the average gain for the full year is 17%. Really compelling. And you're up almost 90% of the time. On the flip side, if you're down in January, on average, the S&P 500 is down, actually down a little less than 2%. So very positive seasonal force here that suggests that we're likely to be up. And then we have a positive chart, right? This is the S&P 500. We're just rising through this channel. We're near all-time highs. In fact, less than 2% from all-time highs. Right now, as we're recording, we're not really overbought anymore. We've digested this big run. You can see the RSI 14 at 51, which is a very kind of calm average number, right in the middle of overbought and oversold. And breadth is not great. It's okay. Maybe that's a bear argument here, but the chart looks good. Upward sloping channel, upward sloping rising moving averages. We've got higher highs, higher lows, and hopefully we can break back above to new all-time highs here soon. So turning to the bear case now, moving quick, got a lot to go through. So the bear case certainly has some good arguments here. Tariffs and trade policy uncertainty. I bet nobody listening is surprised to see that one up here. Next, deficit spending, which certainly relates to the tax cut discussion we just had. Sticky inflation. So Jeff, I'll be relying on you to explain why we shouldn't be so worried about inflation. Number 4, overly bullish sentiment. This has actually become a weaker bear argument lately because sentiment has actually cooled off a bit. But that doesn't change the fact that stocks are richly valued. So that's the fifth point in our bear case. So, and then obviously this is not an exhaustive list. In fact, we could probably come up with 20 points on each side pretty easily, but we think these are kind of big picture, the best 5. So let's start with trade policy uncertainty being high. You've seen this chart from us. Just an easy way to look at how the markets and the media are concerned about tariffs. China tariffs going in now, and those are likely to be ratcheted higher. So I think a lot of this trade policy, relates to that because we're not going to demand too much, I don't think, from Canada. And certainly Canada and Mexico have both made some concessions in giving the Trump administration what they want. So, and we'll get Europe, tit for tat on Europe. We'll probably get universal tariffs, but they're going to be modest, we think. But still, they're negative because, it hurts company profit margins because they're paying more for imports. And then, Jeff, you can talk to, the inflationary impact and maybe the economic impact of, a tit for tat scenario.
Yeah, well, there's just it's such an unknown commodity because you don't know how aggressive our trading partners will respond in some retaliatory trade adjustment to say, "Hey, you're putting tariffs on us. We're going to go ahead and put something on your goods coming into our country." One of the things that we've been writing about here at LPL Research is the fact that in addition to foreign firms bearing some of the brunt of a tariff, as well as domestic firms deciding perhaps temporarily eating up some of that hit from the extra tax of a tariff. Another thing that's the third factor that's perhaps underappreciated is the currency adjustments that can offset some of the factors of the tariff. But despite all those perhaps adjustment mechanisms, in many cases it does hit the consumer. And we can't avoid that, and it's just the uncertainty that is the biggest concern, even though it might not be as bad as you might expect. Just the fear of the unknown could be a challenge for markets. You think about when the pilot says, "Hey, buckle your seatbelts. Don't walk around. We expect some turbulence." Well, it turns out, it's a lot less that you imagined in your head. But nonetheless, that created a little bit of a few moments of discomfort as you're awaiting the chop, as it were. I think in some ways this is why it's fair to put tariffs in the bear case, because you just don't know what kind of impact it might have on markets.
Yeah, good point. We've both been on the road quite a bit lately. I think it's fair to say we've both had that experience. No doubt. I think that the currency piece is very important here because, it makes our imports cheaper if the dollar is strong, which it has been, right? So, um, and China's weakening their currency to try to absorb it. So we're going to get that little bit of a buffer. You mentioned the other buffers from the actual importer and the manufacturer overseas eating a little bit. So it'll have an impact. It'll help us achieve some objectives that the Trump administration has, but it's not going to be the full hit. That's really important to say. So it's still a bear case, and it still presents risk if the retaliation goes, several rounds back and forth, which we saw in 2018 and 2019. By the way, tying this to earnings, we're on track to have the most companies mention tariffs of any quarter ever recorded. So, in fact, I think we're right around 150 companies have mentioned tariffs already, and we're barely over halfway done with earnings season. That's S&P 500 companies. So we're on track to shatter the record from 2018, 2019, where a lot of companies mentioned tariffs, but not as many as this time. So it's a very popular topic, certainly, as we expected it to be, and will be certainly a big challenge for companies to manage just the overall uncertainty. And then once we know what the tariff landscape looks like, do you move supply chains? Do you shift production? Things like that. So let's go to debt now. This is certainly a bear case, no matter how you slice it. Again, we think that the Treasury will be able to manage through this pretty well. We think there's going to be enough global demand for treasuries to prevent our yields from skyrocketing, but it's not going to be easy. And look no further than the 6 trillion column. This is from our 2025 outlook, by the way. The 6 trillion column, that is the amount of treasuries that mature in 2025. So we're going to have to refinance those at higher rates. I believe we're spending 18% of tax revenues on interest costs, and that's only going higher as as these bonds mature, and the interest gets refinanced at higher rates. It's kind of like a mortgage, right? If you've sold a house recently and got a new mortgage, there's a good chance that you experienced what the Treasury experienced, right? Lower rate going into a higher rate. So just if we don't get this under control, and certainly the Treasury wants to, and Scott Bessent has talked about it. If we don't get this under control, the problem just gets tougher and tougher to manage. So a big focus this year, managing through this. And if you're wondering how it's going, just look at the 10-year, right, Jeff? That's the report card.
Yep. Yeah. You can't argue with that. But, in some ways, maybe this is a positive way of looking at this bear case. Um, I think markets are a lot more comforted knowing Scott Bessent can manage through some of these maturing um, treasuries versus the challenging times that we had with Yellen financing debt with very, very short term instruments.
Yeah, Bessent's a markets guy. That's all he's ever been, pretty much, other than, I guess, an academic mixed in there, teaching. I guess he taught classes at Yale, from what I understand. But still, he's a money manager. he knows the markets, and certainly is well qualified to try to manage uh, the Treasury's balance sheet, if you will. So this will be important to watch. In fact, I would argue this might be, well, other than a resurgence in inflation, this might be the biggest risk in 2025, because like we talked about, the tariff risk we think is manageable. And Trump can back off it if he sees that it's disrupting markets too much. This debt problem, you can't really back off. So speaking of inflation, certainly a big risk. This is the break-even rates for the TIPS market. So right now, 2-year TIPS are pricing in inflation around 3% or so, which is lower than what we got from the University of Michigan survey, in which we're going to try not to pay too much attention to, because that said consumers expect over 4% inflation. We wouldn't put too much weight on that. But what do you think here, Jeff? Is this are we going to level off at 3? What gives you confidence that we're going to come back down off of 3?
Well, I think this does make sense to be in the bear category, at least one of the factors, and that is this: markets expected inflation to be a lot closer to the 2.5 rate by going into 2025. A little bit surprised in the uptick in November, December, January. We're going to get that pretty soon, CPI numbers. Now, remember, it's important when we talk about this 2% target that the Fed has. I want to remember, and markets know this, but you want to make sure our audience knows as well, that we're talking about a longer run average of 2%. So the Fed's comfortable with it hovering above, sometimes hovering below, and this is going to average out over time. But the fact that we're keeping at a 3% type of a rate, 2.8 to 3%, that's adding a little more pressure to the Fed. The good news is it doesn't seem as if the economy is breaking, and hence they have the luxury of pausing, just waiting and seeing, looking at all their options, looking at the data, and not feeling rushed into a rate cutting decision or a rate hiking decision for that matter. So we do expect inflation to ease this year, probably in the April data, maybe the March, April data. We'll start seeing that, but this is certainly frustrating for markets right now, seeing inflation still running pretty hot.
Yeah, which is why the Fed's probably just going to hold steady for a while here, right? Still, our house view is still a couple cuts, but it's going to be back end loaded, and I think it's fair to say you're more likely to get 1 than 3 at this stage. But we'll see. We'll see. This is a key risk. We don't want the market to start worrying about Fed rate hikes, because that is enough to drive a market correction. We think we're due for a pullback. We'll see when it comes, but hopefully it can be limited to one of these 5 to 7% kind of pullbacks that we've seen in recent years. Nothing bigger than that, but we don't want to fight the Fed. So as long as the market expects Fed rate cuts, even if it's just maybe 1 this year or 1.5 this year, that can present a pretty solid foundation for stock prices. And as you saw in our 2025 outlook, part of our market outlook, part of our assumption is that we will get those Fed cuts, and stocks tend to do pretty well after the Fed starts cutting. So absolutely important factor. So let's go to sentiment here. So in the outlook, we showed a survey by the conference board. They asked about 3,000 households, do you think stocks are going up or down in the next 12 months? And in the December survey, it was the highest percentage of bulls ever recorded in over 30 years. So that raised some eyebrows. I mean, we already knew there was a lot of optimism out there, but that really put it on paper, right? And this chart here is a little bit different. This shows the relationship between the AAII survey of bulls and bears. So it's the spread between the bulls and the bears, American Association of Individual Investors. It also has a very long history, but this is just a recent look. So that's the blue line. And you see that we've seen sentiment come down a little bit, cool off a little bit over the last few months based on this read. So that's good. You don't want sentiment to be too hot. But the other point here is just look how closely the 3-month change in the S&P 500 follows sentiment, right? It's almost like these survey recipients are just saying, the stock market was up over the last 3 months, therefore I'm a bull. Stock's down over the last 3 months, therefore I'm a bear, right? So sentiment and stock price movements are closely tied together, but I think this is instructive to think about. So sentiment's cooled off, which is good, but we're going to still put it in the bear column because there are a lot of optimists out here and a lot of enthusiasm for stocks as we are near all-time highs. That ties into the valuation argument. We're pricing in a lot of good news. This is the equity risk premium. So it tells you if equity investors are getting compensated for equity risk relative to safe haven bonds, specifically the 10-year treasury yield. And right now, the earnings you're getting from buying stocks through the S&P 500 are not any better than the yield you're getting from treasuries, right? You're not getting a premium of yield versus yield, earnings yield versus bond yield. If you're going to take the risk of stocks, you want to get paid for it, right? So this is saying stocks are really just too expensive to compensate you for the risk. So this is another reason why we're a little bit more cautious than the consensus. We think we'll have a high single digit kind of return year, not a 20% year like the last two. And we think maybe, the market is really dependent on earnings growth to support these valuations. There's a little risk to earnings. We're a little bit below consensus there. Again, kind of high single digit earnings growth. We think maybe 10. And then the consensus is looking for a few more points than that. So when you have high valuations, any bad news that comes tends to be punished more. So you don't know when it's going to come or what it's going to look like. But when it does, you tend to get more volatility. So there's another element of the bear case, a very popular element of the bear case that we think has some merit. So there you go. 5 bull points, 5 bear points. Pull them together. We think we'll have a sort of a choppy, modestly higher year, but probably not another up 20. So Jeff, here's where I turn it over to you to preview the week, and then we'll wrap. So what should investors be watching this week?
Well, we don't have. Maybe I'm looking real quick. I don't think we added Chair Powell's testimony that he's going to give both to the Senate committee as well as the House Financial Services Committee. That's going to be
last minute, without telling you, I added that little line in italics there at the bottom.
You did fantastic.
I'm keeping you on your toes, Jeff.
Nice. Well, this is the semi-annual report to Congress, and this is interesting. Of course, it harkens back to the days when the press was interested in how thick the briefcase was for Alan Greenspan going to these testimonies, as well as, of course, going in and out of the FOMC meetings. A lot of speculation on that. But we learned a lot from these testimonies, understanding how the Fed was changing in philosophy under Greenspan and then Bernanke. But still, with the Powell-led Fed, it's still interesting, still important, still helpful for markets to kind of get inside his brain on how they think about inflation, since it is running hotter than they would like. So that's going to be on Tuesday and Wednesday, 10 a.m. Eastern. Outside of that testimony, we're going to have a whole slew of speakers. In fact, later in the week, we're going to have one of Fed officials talking about some crypto. That's going to be a topic of conversation. So that's going to be important. We'll be covering that in real time. In terms of economic data, you see the stars on the screen. NFIB, National Federation of Independent Businesses. That's important. Gives us a good handle on hiring and expansion plans and input costs at the small business level. Then, of course, on the 12th is the CPI numbers. I hinted that we probably will have to wait and be patient until about April or so to really see this annual rate of inflation start to make meaningful steps downward. But we expect about a 2.9% growth rate on annual inflation with that latest read for January data. So that's the CPI numbers. I think as we try to get a handle on the potential risks in the tariff discussion, a lot of it's unknown, but we should look first, I think, to the PPI, which is Producer Price Index. So that's basically saying, okay, what are the pricing pressures that are particularly unique to those that are importing goods, the firms at the producer level, hence the PPI. Look at that. And then later in the week, we'll round out with a good look on January retail sales. We had a really hot holiday sales in Q4, especially November, December. So this shouldn't surprise us at all, seeing a little bit of a pullback and a recovery in January after we saw a very, very active consumer the end of last year. Import prices, a little bit early. This is for January data. It's a little bit early, of course. No tariffs instituted yet as of this data. So probably not as exciting as import price releases, say, in the next 2 or so months. So maybe this is the calm before the storm. I don't know if that maybe is the right phrase to use. That's probably not the most encouraging, but let's see how these things shake out once we have uh, implementations of tariffs. But these are some of the things you want to look for, get ready for when we move ahead throughout this year.
Yeah, I was certainly thinking, import price index star relating to tariffs. So glad you clarified that they're not actually in there, but that will be a good place to look for them going forward, as well as the PPI, as you explained. So yeah, the data for the next several months is going to be in the context of tariffs, and we'll see. I know, Jeff, you pointed out that in 2018 and 19, when the tariffs flowed through the last time, they didn't really get passed on to consumers. So we saw them in the PPI, but not really the CPI, right?
That's exactly right. It all goes back to how committed and how strong the businesses feel they can be in passing along prices to the end consumer. But you're exactly right. We saw an uptick in producer price index for wholesalers, retailers, but we did not see a material broad-based impact on consumer price inflation back in the day.
Yeah, in fact, consumer prices dropped, um, pretty meaningfully around that time after the tariffs went in. Um, I know. So, this is a different environment. Obviously, there's much more inflationary pressure today than there was before the pandemic. So it's not apples to apples, but still it's encouraging. And when you talk about all those different elements of the supply chain that can take some of the hit, currencies, wholesalers, all of that, these should be manageable. And again, some of them aren't going to go in, right? Or if they go in, they'll just be part of a universal tariff that'll be pretty small. So clearly the market agrees with us that the tariffs aren't a huge risk, but they are absolutely a risk nonetheless. So with that, let's go ahead and wrap. So we got them all in 10 points, five bull, five bear, and kind of tried to pull that all together for you to share the LPL research view for 2025, which is again pretty positive outlook. There's nothing wrong with a high single digit kind of a year for stocks. There's nothing wrong with an economy growing at about 2%, where we can get a little bit of better inflation numbers as the year goes on. But you certainly have some risks that we all want to keep in mind, in particular the trade uncertainty. So with that, thank you, Jeff, for joining. Thanks to all of you for listening to other market signals, and we will be back with you next time. Take care.
Bye bye.